SJ Fibonacci here, and welcome back to 438Forex trading course. And again, I want to say congratulations, guys. If you made it this far, pick up yourself. Before we get started, I just wanna let's just go through the objectives of this lesson and then go through a recap of what we did in the last lesson, right? So lesson 4, we're gonna get deeper into it. Still haven't gotten to the stage where we're gonna enter in trades yet, but I'm still laying the foundation. I'm still laying the foundation blocks for you guys, set you guys for success, right? So what we're going to do today is what we call top-down analysis, which is a big part of the price action I spoke about before. We're going to go through identifying and marking on key levels, so like your daily levels, your weekly levels, the session highs and lows. And then we're going to go through a main tool. But it's probably the only tool I really use, which is called a Fibonacci Retracement Tool. All right, but before we get started, let's just go recap what we did in the last lesson. So we'd have introduced the candlestick, the Japanese candlestick, right? We'd have gone through the anatomy of a Japanese candlestick, right? And they call it Japanese candlesticks because they actually they form like candles, right? We'd have also mentioned that a Japanese candlestick pretty much represents the movement of price within a specific time frame. So it can either a 50-minute candle, a 1-hour candle, or a 4-hour candle. Now, each candle has an open price, it has a closed price, there's a highest price, and there's a lowest price, right? And there are two types. There's a bullish candle. A bullish candle would mean that the price, where the price closes, is actually higher than where it opened, right? So open price greater than closed price is what we'd call a bearish candle, right? So the thing about it, I always say, think about how the bull attacks. The bull attacks from up down, so the price starts lower and closes higher. The bearish candle, the bear attacks from up down, so the price opens higher and closes lower. And then now the wicks are what we use to represent the high and the highest and the lowest point the price went for this specific time period. But I've also gone through market structure, right? 3 basic market structures. They're uptrend, downtrend, consolidation. And again, if you guys want to see the definition, you can just go back to lesson 3 and go through that. We also have support and resistance, we call price floor and price ceiling. And then we'd also have and I'm gonna show you how that ties into what we're doing in the next lesson, because the key levels I mentioned in the objective for lesson 4 are usually, not usually, but yeah, they usually become price ceilings and price floors within the market. And then we'd have gone through the trading session, right? We had Asia, London, Sydney, New York, and as I said, these are the major financial centers in the world. This is where the big banks, hedge funds, the big guys are. These are the ones who are really moving the money. I would have gone through TradingView, and TradingView is the tool that we use to the charting, which we're going to use in lesson 4. It is the tool, online tool, free to use. They're free access or free versions of it that you can use to go through and track price and manage your trades and pretty much be able to execute your strategy. Now, let's just go straight into it, right? So I'm just going to bring up TradingView, which is a charting tool that we use, right? And they're pretty much, so you notice I only mention, I mentioned the weekly, the daily. So those are, so I use like pretty much 4 time frames. I use the weekly, the daily, 4-hour, the 1-hour, and I might go down to the 15-minute. Don't always go down there. I want to go down there when I try to map on like session highs and lows, right? But essentially, this is what the chart looks like. This is a plain chart. There are no markings on there. I have all my candles black, but you can decide how you want the candles. By clicking on the candle, you can actually change the color of the candles. Whether you want your up candle or whether you want your bearish candle to be a certain color versus your bullish candle to be a certain color. I mean, I like. But this actually I actually got from Sean Lee. So Sean Lee, big up Sean Lee, one of the greatest traders in the world. That's where I got this thing from. And it just kind of helps with the psychology, right? Because red, we usually know red to be dangerous. So usually what happens is the default levels on the chart, the default setting on the chart is that the red candles are the bullish. The red candles are your bearish candles. And already the omelette can represent kind of danger, so it might make you panic and stuff. So just change it. That's the thinking. So I just change all into black. All right. But essentially, let's go straight into how we map on the weekly levels. So the weekly levels, we go to the weekly time frame. So you have to be in the weekly time frame to put on the weekly levels. And you usually use the tip of the candles. And it's usually where price reverses. So you go to these levels where we have major price reversals. As you can see, price is in an uptrend, price pushing up, it just came to this level and just start reverse and it went down. So you want to map on that level. And you also want to be mapping it at levels close to where the current price is, right? So you wouldn't go all the way down here. So you wouldn't go all the way down here to come upon this. This wouldn't be any use to you because the current price is far away from that, right? So you want to go to the closer levels or the levels that are close to where the current price is. For this, so you can it's two ways to do it, right? You can Alt H, so Alt if you're using a laptop, Alt your laptop, and you put it on, or you can go to the tools here, and you look for the horizontal line. And I keep mine black. So black horizontal line. That way when I see a black horizontal line anywhere in my chart, I know it's a weekly level, right? And then I usually go down, somewhere as close to price. So let's say I went probably here since this one is recent. Alt H, I throw it on. As you can see, the price actually. So this is there was previous activity around this area. There was price would have reacted this area previously. So all the way back to July of last year, literally a year ago, price actually reacted to this level before. What I also try to do is to keep the levels like around like 25 or so, or even 3. I don't know how far I will go if I put 3, if it actually is, no, that's too high. But essentially, try to keep them at round levels, right? Because people eventually they trade at, you trade at really round levels. You don't trade at 3 decimal places and stuff when you're really trading, right? Even though the prices do reflect that. So you kind of try to keep the levels them round. So I did that, right? Now, the other 2 weekly levels I put on is the most recent weekly high. So this would have been the week that ended last Friday, right? And last Friday, so this will be the level that ended last Friday. Now, what you want to do is to go here to the same thing. You put on the level, Alt, H. Hey, what's going on? That's it, right here. Alt H. I also want to mark on this one. So it's Alt H. But for these, I normally leave them because I always want to know last week's high. All right, so we're actually operating this chart right now. The market is closed, right? So when I'm recording, this market is closed. When you miss it last week, this is because I'm recording on the weekend. So last week's high, so the market is closed. I usually do these analysis on the weekend when the market isn't open. Did I put last week's? What did I say? Last week's high, and then this would be last week's low. So I always want those mapped on. But essentially, what top down analysis is. Wait, did I already mention what top down analysis is? I think I just jumped straight into it. But essentially, what top down analysis is that using the price movement in the higher time frame to determine the directional bias that you're going to use on the lower time frames. Because I'm a day trader. I trade on the day, on the week, on the 4-hour level, on the hour level. So I'm trading during the day. I'm not trading on the weekly level. I mean, yeah, I don't trade on the weekly level, right? So I don't take trades on the 4-hour. I don't take trades on the weekly level. I trade on the lower levels. But I use the 4-hour. I use the weekly level to determine my directional bias on the lower time frames. Because the structure on the higher time frames are pretty much, I said, they're stronger. Or use it to determine directional bias. Right? So, and that's what essentially top analysis is. Top analysis is using your higher time frames to determine the directional bias on your lower time frames. And we trade on the lower time frames. At least I trade on the lower time frame. And I'll be teaching you to trade on a lower time frame as well. On a lower time frame. Now, after you've mapped on your stuff on the 4-hour, then you want to map it on to the daily. Now, similar to what we did for the most recent high, it's the same thing we do for the daily, right? So this would have been last week, Friday. I put on the high for last week Friday. Because we're at the end of the week though, of course, because we're at the end of the week, because the last candle printed is the end of the week, then you wouldn't have to put on the daily low because it get mapped back to the weekly low. Which isn't necessarily always the case when I think about it. So I'm not sure why I said that. Which isn't always the case. But in this case, because the week ended down here, the week low and the daily low end up being the same thing for this specific day here. And essentially that is kind of how, you know, and I go through. So because my directional bias, so all right, so let me tell you now, based on what is happening here, my directional bias is going to be down. This candle, this weekly candle that engulf these other candles, I get this massive momentum going down and engulfing these candles. I'm of the view that the market is going to continue to push down into this level here, is what I am thinking. So my directional bias is down. Right? That doesn't mean the market can start dropping immediately when it opens, you know. It might end up pushing back up here. Which way I mark these levels, because it might push up back here and then continue to fall and so on and so forth. Now, if I'm expecting to go down, I also want to mark on the daily levels that I think are important, lower than where price is. So this level right here, where price would have reversed, I kind of want to mark, right? So I'd mark that level on as a daily level. So that is a daily level I want to mark on. And essentially, based on where this is now, and that is what I'm going to put on daily level. So my daily level, the daily levels are marked with what we call the ray. So you go here and pick up the ray, and I usually have the ray is blue. And that's it for the daily levels and the weekly levels. Right? And I'll tell you, we use these levels. So these levels represent support and resistance. They're price ceilings and price floors within the market. So you see it came here in reverse, so it created support here, and so on. On the 4-hour, I don't really map levels on the 4-hour. I use the daily levels that I've mapped on the 4-hour. I mean, if I wanted to put it on a daily level, I could actually put this one on, which is essentially just another level lower. Right? So if I was going to use that, if let's say the market decided to drop, if I was going to use a target, it would be this level at 184.5, 184.5, right? So I put this on right here. And also, I don't try to put on too many of these markets in the chart. You want to keep your market chart and clean. So chart cleanliness is an important thing as a trader. You want to keep your chart clean and so you can read the price action. You don't want too much things funny, you can't even read the price action in terms of what the price doing, right? I also don't want to get them too close, but I'm okay with the way this is right now. I don't really put on levels on the 4-hour. I'm not really fan of putting on those, even though they can be put on. The session highs and lows now. I actually already have on the session indicator, but let me take it off for now. Let me just remove all indicators. But essentially, this is what a naked chart would look like when you go on TradingView. Now, I don't bust my brain to determine when the sessions are started. All I do is go to indicators up here. You click on, it's called the CM4X sessions highlight. At the indicator, what it does, it gives me the trading sessions. I've gone through this in previous lessons. But the green or whatever this aqua is New York. The white space is where the crossover takes place. That's where they are both run at the same time. So there's a crossover. The red is London, Asia, which is the longest session, is this purple, and the yellow is Sydney, which is very small and very low. You want to stay away from Sydney. You don't trade in Sydney. Look at this. Dead volumes. Nothing is going on in Sydney. Market already moved in Sydney. All right. And then from there now, I put out what we call session highs and lows. Now, you can mark them on anywhere. I usually mark them on a 15-minute, and it pretty much just represents the highest level the price would have been. The highest level the price would have been in that particular session. So look at this now. This is Asia from Wednesday night. And the market how you draw in the session highs and lows is you use they use the rectangle tool, and you mark from the body of the candle all the way to the wick, and then you just kind of just extend this. What you actually find is the market actually uses these levels as levels of support or resistance. In this case, it is resistance. I remember resistance is a price ceiling. Price can't break below it, so it falls back. So based on that, you'll see that Wednesday, yeah, the market is pretty much been respecting it from Wednesday all the way into from Wednesday night all the way into Friday. The market was respecting this level, right? If you want it to show on the 1 hour, which is usually the only time frame I love it to show on, you can double click on it, click the visibility, click 1 to 4, just click 1 hour, update so the range is from 1 hour to 1 hour, and it will show on your 1 hour chart. And that is so essentially we just use again these levels are the support and resistance levels. As remember, these are levels that price reverse out of. They go in there, they retest them, reverse, that they break through them, test them back. So we use these levels as levels where we enter. So that's essentially, so let me just make it clear, that's why we mark it on these levels. We use these levels as levels where price reverses or reacts, and we use them as levels to enter the market, enter trades from these levels, right? Because if you know that the market is respecting this level, if you know the market has been respecting this level, this is a level that you'd want to enter the market in, right? And again, you use this in accordance with the trend that the market is in, right? Using accordance with the trend the market is in. So let me just see what exactly I've covered so far. Let's see. So went through top-down analysis. Again, top-down analysis is where you try to determine a directional bias using the higher time frames, right? So that if the market is in a week, on the weekly level the market is in a downtrend, then you shouldn't be looking to be buying, because the higher time frame where the volume is happening, the market is trending down. You should be looking to buy. So use a higher time frame to determine directional bias, and then use that directional bias to trickle down to lower time frames. So you start high. So essentially, you start high. So when you're going through the chart of the analysis, you start from the higher time frames first, and then take your time, come down, which is what I just did. So I went from weekly down to daily. But let me just go in there a little bit more. Let's go in there a little bit more. So we have the weekly, we have the daily. Now, based on what I'm seeing on the weekly, right? I expect my market to come down, continue to fall, because of this big candle here. This candle engulfed like about 3 candles, and it took out the lows. It took out the lows here of multiple weeks. So the last 3 weeks, it took out the low for the last 3 weeks, right? So because my direction bias is down now, I'm going to look for confirmation of that on the lower time frame, which is now the weekly, the daily, right? So the market would have broken the structure. Here it took out this low, right? So break through this low. And so again, the volumes in it is the same. Massive bearish candle. Market is going down. Right? I keep going down to look for the confirmation of that. So the same thing here. On the 4 hour, the market pretty much rejected this daily level twice. So it went in there, couldn't break it, went back up, couldn't break it, and now it's falling. Right? And I'm expecting to fall into this level. So that's kind of how you do the top analysis. Start from the top. Might have to do some more sessions on the top analysis because it's not really as straightforward, but essentially it's for you to determine a directional bias. Direction, whether they're going to be up or down based on what's happening on the higher time frames. So they continue to break it down until they reach like down to the 1 hour. I don't really go beyond the 1 hour. Right? So that's essentially top down analysis. And the weekly highs and lows, the daily session highs and lows, you use these levels as levels of resistance and support and areas where you want to be entering the market from. Right? So the last thing objective, so again, it's kind of a quick session. The last thing objective is the Fibonacci Retracement Tool. Now, this tool is a big part of my arsenal and how I trade as a trader, right? It's a big part of how I trade. Now, what the Fibonacci Retracement Tool is, as you probably can guess it, is what I use as a part of my moniker, SJ Fibonacci. is because I use Fibonacci so much. A big part, my bread and butter, a big part of how I trade information. All right. Let's see if I can find something. All right. Let me just kind of show it. So the Fibonacci retracement tool is based on actual Fibonacci sequence. Fibonacci sequence was discovered by a mathematician. I don't want to go into the math of it, but it's based on that Fibonacci sequence. You guys can Google what Fibonacci sequence is. We don't necessarily need to go in there to figure it out. But what somebody, and then there's some smart person who realized that when the market makes these runs or pushes, right? So for example, the market pushes, so we swing low, market swings from down here all the way up here. Some genius realized that when the market retraces, right, on average, the market retraces, or this is a retracement. So the market push up, it makes a correction or what we call a retracement. They found out that the market on average traces back to 61.8% level on this tool, meaning that the market retraces 61.8% of the move that it made. So it reverse 68.1% of the initial movement. So the market swing from here all the way up here. Right, there are different levels. So there's 78, there's 100. If the market comes all the way back here, it means that it would have reversed 100% of the move. So it pretty much has come back to where it started. Right, so that's 100% reversal, retracement. But they found out that on average, it normally retraces back to 61.8% of the move, or between 61 and 78. So how I use the tool is between 61% and 78.6%. And then now, so what we say is that the market retraces here before it continues to push back up. So because the correction. So news coming out of the market, react and it move up, the market corrects itself, makes a reversal or a correction. It comes back to 61.8, and this one came back perfectly. And then if you look, this actually coincides with a daily level. So that's how I use the levels too. So I remember telling that I use the levels for entries and also for exits. So this will be a perfect setup for me in terms of how I would use this. The market push down. I mean, this is a conundrum trade, which I wouldn't necessarily do, but just for the sake of showing how the two works, right? So that's so when you enter this now, typically you want to take profit or your exit to be around back the zero line or the negative 27. You're pushing for negative 27. All right, but let's see how it actually did play out. All right, so you see it reversed from here and it pushed up. So it didn't quite get there, but then what it did is it made another retracement, right? So now you can move your fib tool. So you have a new swing high now. So your new swing high starts from where your previous 61% level was, all the way up to where it actually started to retrace again. And look at that. It dipped back right into the same level. So it push up, dip back into the same level. Now let's see how it actually plays out. So again, it respects the level. It pushes up, and it got to the level that you want. It got to the negative 27 level. You could consider this a retracement, but I don't really use these other levels because this would be a percentage of the retracement, but I don't use these levels, right? I use this between 61 and the 78. And that is how we use the Fibonacci tool. So essentially, it's for us to be able to tie in everything together, which I'm going to end up going through in probably the next lesson to teach a specific strategy that I use. All right. But for now, these are the foundations that we need for that for lesson number 5. All right. So this is our Fibonacci retracement tool. Now it's available from here on the panel. It looks like this. There are multiple versions, but what you want is a Fibonacci retracement. Now when you put on your charts, you're gonna have to customize it. So you go to double click on it, you go to style, and you want to only have these levels on there. You also want to have the 0 level, 100%, 1. You want to have the 0.618. You want to have the 0.786. And you want to have the negative 27. So those are levels you want on there. And you want to also turn off the trend line. You want to unclick these extend left, right, extend lines left, let's extend lines right. You want to turn off the background, and you want to turn off the reverse. And that is pretty much it. But what I want you guys to actually do for your homework, so I'm going to give you guys homework. Right? What I want you to do is to go to tradingview.com, pick any Forex pair you want to pick, right? Make sure it's clean like this. You might have it when you open it, you might have the red candles and the green candles. Again, I don't use red candles and green candles. All right. So I want you to go on there, and I want you to map on these weekly levels that you see. So any level where you see your price reverse out of these wicks, I want to put on the horizontal line on these wicks. So I want to put the and this kind of pretty much creates a range. If you look at it, it creates a range where price is possible to play around in. You put on one up here, one down here, and you can put on your last week high and your last week low. All right, and I want you to do the same thing on the daily. So go to your daily, put on your daily levels, which is the blue line ray. Put them on. And I also want you guys to customize the Fib. Fibonacci. You can make it any color you want to make it, but just make sure you have all the levels that I would have mentioned earlier. All right, all the levels. So you have one 100%, a 78.6, a 61.8, and also a 27, a 61.8%. I think I need to show you guys. I'll show you one type of Fib, right? Let me show you another one. So the Fib I just show you is where the market was in an uptrend and it retraces back, it retraces down. I need to show you one when it's in. All right, let's look at this one. So here the market is in a down. This section of the market is in a downtrend. So you're going to go from swing high to swing low. From swing high to swing low. All right, so from swing high to swing low, the market retraces. So this is the rule for the Fib, right? You're looking for price to reverse between these levels, these two levels. Really and truly, if it goes beyond this level, then the Fib is invalid. Or whereas if it goes beyond the 100, that means it completely reverse. And it's not going to continue the trend. Right? So be mindful. It's between these two levels. So it can be at 61, in between the 61, and this one end up closing perfectly. It closed right below the 78.6% level. Right? And again, the target is usually, I usually take my first target here, or my aim is to get to 0% here, or negative 27 based on what the volumes, the momentum looks like. All right, see, it actually got there. And that is it. So, recap of homework. I want you put on your weekly highs, your daily levels, and customize a Fib. And remember, the takeaway from this session is that we use these weekly levels as areas of resistance and support. And remember that we use resistance and support as levels to enter trades from. Because usually price reverse at these levels. They use them to enter, and we use them to exit. So they're usually like the target levels, and they're usually where you want to be entering. Where it's not just entering from there, right? You have to enter it in the context of everything else in the market, which I can end up teaching you guys or showing you guys in lesson 5. Remember, if you have any questions, you can put them in the chat. You can email me, 438Forex@gmail.com. If you know me personally, you can also just reach out to me, and I'll see you best I can assist. But until next time, guys, let's see what's going to out.